Dividend ETFs versus Growth ETFs, which investing strategy is the best for beginners in Singapore. Today, I will explain the difference between them and which strategy is right for you. Stay until the end because I'm going to compare the returns of the most popular dividend and growth ETFs. The difference is going to surprise you. Okay, let's start. First, what exactly is a dividend? When a company makes a profit, they don't always keep all of it. Instead, they share a portion of that cash with their investors as a thank you for holding their shares. That cash payment is called a dividend. The types of companies that pay high dividends have usually done most of their growing. For example, Johnson & Johnson, PepsiCo and Singapore banks. They are incredibly stable, but because they have already done most of their expansion, they don't need that much money, so they return that cash to you as dividend instead. That means their share prices don't generally experience explosive growth, but they pay out high dividends consistently in good years or bad years. Now imagine trying to build a portfolio of this company yourself. You have to research dozens of them, track their dividends history, monitor their finances, and pay a trading fee every single time you buy one. Most beginners are not ready to do that. That is exactly why most people go for an ETF. A professional fund manager has already done the screening. Financial stability, consistent payout, solid track record, and bundle the best one into a single fund. You just buy one ETF and instantly your money is spread across hundreds of companies. If one cuts its dividends, you barely feel it because you have got hundreds of others still paying you out. If you are finding this video useful, take a second to hit that subscribe button. I make evidence-based investing videos to help you cut through the noise and stay focused on what actually works. Subscribe now so that you won't miss the next one. But here is where most beginners get stuck. There are so many dividends ETFs out there. It is hard to know where to even start. The two popular dividend ETFs Singaporeans keep talking about are the ES3 and the CLR. These two ETFs are just the starting point. Please understand your risk tolerance and do your research before you invest. The ES3 or the Spider Straits Times Index ETF invests in Singapore's 30 biggest companies: DBS, OCBC, Singtel, and CapitaLand. At the time I'm recording this video, it pays around 3 to 3.5% in dividends. The CLR or the Lions Philippe S-REIT ETF invest in REITs. REITs are basically companies that own properties like shopping malls, office buildings, and warehouses. Instead of keeping the rental income, they are required by law to pay most of it out to investors like you. At the time I'm recording this video, its dividend sits around 5.5%. Now, here is why the ES3 and the CLR make sense for Singapore investors than the wildly popular US dividend ETF like the SCHD. First, when Singapore companies pays you a dividend, our government doesn't take a cut. Compare that to the US dividend ETFs, the US government automatically take 30% of your dividend before they even reach you. Second, there is currency risk. You buy in US dollars, but you spend in Singapore dollars. If the US dollar drops, it eats into your profit. Many dividend investors are retirees who need steady income. They want everything in Singapore dollar so they don't have to worry about exchange rate. Of course, there are many other great Singapore ETFs that pays dividends. If you want a full comparison, including which one I invest in, the link is in the description. Go check it out after this video. Here is a wasted opportunity for beginners. While you are still figuring out where to invest, your cash is still sitting in a bank account doing absolutely nothing. Every month you wait is leaving money on the table. Longbridge Singapore sponsored this segment of the video. I use Longbridge Cash Plus to park my idle cash while I decide where to invest. Over the past year, it has returned around 1.5% on its own, already better than most Singapore banks' account. But right now, Longbridge is stacking an additional 5% interest boost on your first $4,000 for a full year. That boost alone is worth $200 in free cash. Previously, that boost was only applicable to your first $2,000. Now it has been upgraded to $4,000. Assuming the fund performs the same going forward, your total return will hit 6.5%. So while you are still deciding where to invest, your idle cash is already making money for you. And once you are ready to start investing, Longbridge will actually pay you to make your first trade. If you deposit just $500, keep it there for 30 days and make one trade, you will get $50 in free Nvidia shares. That is an instant 10% return. If you stretch it to $2,000 and make 3 trades, you will walk away with $80 instead. I have already claimed mine. These rewards are exclusive to my channel and will not last forever. If you want to sign up, scan the QR code on the screen or hit the link in the description. It costs you nothing extra and it helps to support my channel. Thank you so much, and let's get back to the video. Alright, we have covered dividend ETFs. Now let's talk about growth ETFs and why some people never touch dividends at all. The key difference with growth ETFs is simple. Instead of paying you dividends, this company reinvests every single dollar straight back into their own business. Think of it like comparing Nvidia to PepsiCo. PepsiCo isn't trying to reinvent anything. They sell the same drinks, make a steady profit, and hand most of it back to you as a 4% dividend. Nvidia pays you almost nothing, but they take every dollar and pour it into building faster chips, AI infrastructure, and wherever technology is heading next. You get very little cash upfront, but if they are right, the share price climbs far faster than any dividend stock ever would. When it comes to growth strategy, most Singaporeans go with a market cap weighted ETF. Market cap just means the total value of a company. So the bigger the company, the more your money goes into it. Unlike dividend ETFs that ranks company by how much they pay out, these rank them purely by size. According to JP Morgan, there are over 12,000 ETF listed globally. For beginners, picking the right one can feel overwhelming. To get you started, 3 commonly discussed ones among Singaporeans are VWRA, ACWD, and IMID. Please understand your risk tolerance and do your research. These spread your money across developed markets like US, Japan, and Europe, and fast-growing emerging markets like Taiwan and India. They are based in Ireland, low cost, and run by established fund managers. Why Ireland? Tax. If you buy a US-based fund, Singapore investors get hit with a 30% US withholding tax on dividends. But Ireland has a tax treaty with the US and that cuts that down to 15%. Now you might be thinking, wait, I thought growth ETFs don't pay dividends. They actually pay a small dividends, but here is the thing. Because Ireland domiciled ETFs can be structured as accumulating funds, that dividends never hits your account. It just gets quietly reinvested back into the fund. If you want to watch me do a full comparison of 6 global ETFs Singaporeans can't stop buying and which one I invest in, I have put the video's link in the description. What is the catch? These Ireland ETFs are mostly bought through interactive brokers. Signing up interactive brokers can feel like a multi-day job interview, and the app looks like it was designed back in the 2000s. Some people I know just give up halfway. If that is you, you can consider the US alternative VT, Vanguard Total World Stock ETFs. You can buy it using Longbridge. I created my account in under 10 minutes with SingPass. The app feels polished like a proper native app. You pay a little bit more dividend tax with VT. But remember, US-based ETF usually have a lower expense ratio than the Ireland domiciled ones. So we have covered dividend ETFs versus growth ETFs. Now the big question everyone wants to know is, which one actually makes you more money? It all comes down to total return. Total return is capital gains plus dividends. But here is something most beginners get wrong. Dividends are not extra money you get on top of your returns. When a company pays you a $5 dividend, the share price drops by roughly $5 on that same day. You didn't gain anything. You just move your money from inside the investment to your bank account. So total return is the only number worth comparing. So let's look at the numbers. I compared 2 popular ETFs, SCHD, a US dividend ETF, against VUG, a US growth ETF. 14 years of data from 2012 to 2026. $10,000 in SCHD grew to around $50,000. That is 5x your money. Already a great results. But $10,000 in VUG, that same investment grew to around $90,000. Nearly 9x, almost double SCHD. Even with every dividend reinvested, growth won by $40,000. Why such a big gap? VUG is packed with Apple, Microsoft, and Nvidia. Companies that pays almost no dividends and instead pour every dollar back to growing their business. SCHD holds more stable, slower growing companies. But here is the catch. Look at the chart. VUG is a much bumpier ride. In 2022, it has fallen 40% from the top to bottom, while SCHD was quite flat. That higher return comes with higher volatility. Of course, past performance doesn't guarantee future returns, but over 14 years across thousands of companies, That $40,000 gap is hard to ignore. If you are still building wealth and have a salary, you don't need cash right now, so you can afford to ride out the ups and downs. Growth ETFs gives you the higher potential returns. If you are retired or close to it, dividend ETFs gives you steady cash to live without the big ups and downs so that you can enjoy your retirement. Neither is wrong. They are just built for different seasons of life. But that is not the whole story, because there's a whole other debate about dividends are not free money. Dividends companies have run out of growth ideas. You don't even need dividends. You can just sell some shares. In my next video, I'm going to break down every single one of these arguments and give you my honest take. Subscribe because this one is going to be fun.